This conference will now be recorded.
Hi, everyone. It's Larry Lenski here at the agency. We'll get started now. Thanks for joining us today. We have about 20 auditors around the country and have myself and Jill Kelly here at the agency. And the webinar is scheduled for an hour and a half. After spending about half an hour covering the AR in general, we'll spend about an hour on the mortgage section and the special purpose framework. And we're also recording this so someone could listen to it afterwards, although at this one we did a few weeks ago, the recording didn't work, so which is why we're redoing this one. Theoretically, it's recording right now. And just around technical things, if you run into any technical difficulties with this, you can just call the agency and dial extension 202, and Vicky, who's also at the webinar, will help you out. And if during the presentation, feel free to jump in and interrupt at any time or raise your hand. Is there a way to raise your hand? I'm not even sure. In this section, but you can also send a message in the chat section and we'll be monitoring that. But if all else fails, just start talking. And in general, it's nice and quiet, so I guess if you keep yourself muted, especially if there's something going on in your office conversation, and then just unmute yourself to talk. But it's really, feel free to just jump in at any time. What you should see on your screen right now is just it's a big thing that says webinar participants, and it's saying to have this particular document that we emailed you, would have been yesterday and sometimes before, because this document, they are refreshed in the special purpose framework, is really, we'll be going through it today, and it'd be good for you to have it as basically a handout or on another screen, because we won't actually have it on the monitor. We'll be showing you the actual live AIR, but what I'll be doing is actually going through this document. Let's see, and so where we start, we're going to start with getting help, and for that I'm going to bring a different screen in right here. And essentially, when you log on to Chase, our system, what you see is you'll see in your situation, see the name of a number of your cooperatives. And over here, if I click on Help for Auditors and Accountants, it comes up with this list. And then under Reference Documents, it has a list of documents. And these are the core help documents there. And I'm going to just go through these now just to remind you of them. One is the first one is the AR guide for auditors. And let's see, this one is, let's see, I'm going to bring this over on the screen. And it's just been redone to deal with the new AIR, and this basically goes through the entire AIR and has most lines on the AIR itself. So this is a good resource to have. Either it's a PDF document, either keeping a copy handy or knowing that you can always access it through this menu. I'm not going to go through the next one. Let's see, that's an old document, the online rent supplement claim and the renovation claim. The next document here is the pre-audit AR checklist. And this is a document that we send out. We've sent it out to auditors a number of times. And also we send it out every year when we send it out to each co-op and saying your year end is coming up and to get ready for your audit. And I know that some audit firms have your own pre-audit checklists, and what this does is what we find is, like, if a co-op actually follows through and does all the steps on here when you show up to do the audit, that the co-op's well prepared. So we encourage you to encourage your co-ops to actually go through the checklist, to use the checklist, like I say, and to prepare for the their audit. Let's see. And then the next document is the special purpose framework, which we'll be going over today. And this is a new document that you just received recently. And again, it's located, this is a place where you can find it. And the last document is the handout for today. So the document that hopefully you have at your side today to use. And again, it's available online, both at this point and also if you're in an AIR itself, they're all available as reference documents. And the other thing about the, let's see, I'm going to go here over to, now for today, set ourselves up, and if you have any questions, suggestion to do is look at these documents first, especially the one that's a handout. And then if you have any questions, just always feel free to get hold of Jill or myself at the agency. Let's see. So these are some test co-ops I've set up here. And one of the things that I wanted to show you first off is simply that, like I showed the auditor's guide before, but in most sections, like I'm going to just click on, I can click on any of these line numbers, and what it does, it actually takes me to the online help, which is exactly the same as the auditor's guide, but it takes you to whatever line, any section that you went to. So it's a context-sensitive help. And up on top here, what I have is these are all the different sections. So basically, by one click, you get to the entire AIR guide. And I know sometimes I find it helpful to go there, trying to figure out exactly what's supposed to go on a particular line or a particular area. And so where we're going to start today, so that's the getting help section of the document. And the next thing on there is the assessment value. And so on the profile, let's see, cooperative profile, and let's go down here. And I'm going to hand it over to Jill now to go through some of the sections on the AIR.
Thanks, Larry. Welcome, everybody. So as you can see, it's line 71 and 73 down below of this screen, assessment value. On some of the versions of the AIR, this has been there for quite a while, but it wasn't required to be filled in. Now you won't be able to file if it isn't filled in. And we've been hearing that the easiest place to get this information is from the property tax bill for the co-op. So that might be a common reason initially that it won't let you file. So next up, unless there's any questions about that, we can move on to the representations. There's a few changes there, not too many. Okay, we'll start with representation 120. So this is the one that talks about the method of accounting, whether you're using the special purpose framework or GAAP. And as you can see on the handout, your first choice will be to pick between those two. Which one are you using? So if there's some of each, the way to choose is by how the amortization is being done. So if you're amortizing by principal repayment, you can go ahead and call it special purpose framework. And if you're not, then call it GAAP, even though you might be doing some other elements of the special purpose framework. So if you do say that you're using the special purpose framework, you'll get the other questions that have been there in the past. It is helpful, I think everybody for the most part does, to make sure that the policies that you're using are recorded on the statements and that they match what it says here. Now, in terms of the special purpose framework, we will be reviewing that a little later in the webinar. So some of the other ones are...
Jill?
Yep.
Just one thing I want to emphasize, that as it says in the handout, that the key, like you're saying, the key is whether you amortize according to principal repayment or useful life. But we now have some situations where some capital assets are amortized one way and some the other. And so in that situation, you want to answer depending on how the first mortgage is amortized. And so in for instance, the example that's up on the screen here, if we look at the note down below, it says capital assets funded from the first mortgage are amortized at the rate of principal repayment of the loan, and those funded from the workout loans are amortized to income over their estimated useful life. And so what we ask is, first of all, in terms of whether we're saying this is special purpose framework because the first mortgage is amortized at the rate of principal repayment, which is what the vast majority of co-ops do. However, we answered C, no, because it's not that all debt financing proceeds are capitalized that way, and so we put a note in here. This can be a little bit confusing, and we have found out later is because we're suggesting that workout loans, workout funded assets be amortized according to GAAP. And so, but just again, deciding whether something is special purpose framework or not is it's really based on how the original assets, capital assets, are whether they're amortized according to principal repayment or not. Back to you, Jill.
Okay. Are there any questions about that? Is that clear to everybody? Okay, so the other representations are listed on your handout. I think they're pretty straightforward. I just point out representation 123. Want to move down to that one, Larry? Larry's distracted. So 123 says that the co-op is fully compliant with the terms of any mortgage loan it's taken out to replace or supplement its original financing. And we've added this because a number of co-ops are refinancing their first mortgages or getting new mortgages, and there are usually conditions on those mortgages. So it's useful to see if the co-op is in compliance with those conditions. Obviously, that would be a risk issue. So that was the only representation that I was going to comment on. But again, if anybody has questions about any of the other ones, now is the time to ask. I might mention on 126, just so we don't get confused about that, we're wanting to know if the co-op has written off amounts owing from current residents. So we're not talking about setting up an allowance. This would be if you actually then wrote off the debt against the allowance. So an allowance on current members would be no for the answer. All right. Next up is capital expenditures. And we'll start maybe on Schedule H, although this also applies to Schedule D, where you're adding new assets, recording them as capital assets. If you start with Appendix A, take a look at Appendix A of your handout. It's got a whole list of categories and subcategories of capital repairs and replacements. And so when you're recording expenditures, they should be recorded by the type of expenditure. We are emphasizing to co-ops and management companies that it's their job to do the categorizing before the audit. So hopefully you will get this in a decent order. And ideally, this breakdown will agree, this is our hope, that it will agree to the co-op's capital plan, so it will facilitate monitoring for both the co-op and the agency. So here you can see with Schedule H, the example of doing the breakdown. And if things have been lumped together, you know, we're not trying to get down to the penny, so there is always an other option under both sides of this. So you can choose other there and then other and put it in the detail. But also say under unit interiors, you could choose unit interiors. And there's a spot for an other. So if it was a combination, you could say other and put the combination and the amount, especially if it was not a huge amount of money. So then if we go to Schedule D, you'll see a similar situation. So expenditures, additions to capital assets get some, you know, the same treatment. And that whole section now, we've always had D80, but now there's D81 and D82, and all of these together should agree to any change in D10. So if any assets have been removed because they're no longer in use, then that would go on D81, and any other oddities would be on D82. Now, in some situations, especially in workouts, Schedule S was used for capital expenditures, and we're trying to move away from using Schedule S for that. So, Larry, correct me if I'm wrong about this, but we're recommending that you use Schedule H, even if the co-op is not making regular contributions to their replacement reserve during the workout, and then you just transfer to cover a deficit in the replacement reserve. So it ends up at 0, but you see those expenditures going through Schedule H. Is that clear to everybody?
Right.
I'm going to go back to Schedule H for a minute. And so that is line, where are we putting that these days? There it is.
It could be line H70 here, other transfers from and to. Yeah, it would be line H70.
Okay, with an explanation.
Explanation. So yeah, so essentially, because some co-ops and workouts, one of the conditions is they can't maintain a replacement reserve, and the way we interpret that is that their balance has to begin and end the year at 0, but we want to run capital repairs still through Schedule H, so we can track them that way. So the expenditures would be whatever they are. Like in this situation, if the beginning balance was 0 in the reserve, then we spent 370,000. As it says here, what we would do is we would put in 370,000 in here in order to offset the expenditures. Right. Back to you, Jill.
Okay, well, are there any questions on any of that? Okay, then I think my part might be finished, Larry, and it's back to you.
Okay, so I'm gonna switch things here. And some of these things I should have mentioned before are new for, they're new in the current version, and for some of you there that have co-ops with rent supplement programs in Ontario and PEI, you've seen these before. And this is the updated section on the properties and units under cooperative properties and units. What you're most used to seeing is something like this, and which has the detail for a particular agreement. Most housing co-ops just have one agreement. Some have multiple agreements, and some co-ops have non-CMH units also. So I'm going to just go through the different sections here. That the first section here is our CMHC agreements, and in this situation, it's showing that this co-op has one agreement. And again, if I click on the agreement, I get to the detail page, and this is what you update each year, remembering that the housing charges in here are not the housing charges the AIR that just passed, but they're as of the beginning of the new year. So this is this return is for the year ending June 30th, 2019, and the housing charges are as of the next day, the 1st of July, 2019. And then to get back to the list of properties, I go here. Now, if this co-op, the co-op may also have provincial program units, or it may have other units which are not funded by government. It could also have former CMHC units, and if it had that, they would automatically be listed here, because some co-ops, they have multiple agreements or multiple programs. The agreements expire at different times. So if this co-op had some CMHC units and some that were former CMHC units, there'd be a whole other section in here that would list again the agreement number from when it was active, and it would carry forward whatever information there was from before. The ones that are not straightforward is, let's just imagine, and in fact this co-op may have some, that it has some provincial program housing operations. The first year, you actually have to enter the units. This is new, so I'm going to just put something, and there I put an address. And as soon as I do that, it takes me, and then I fill in the units. And again, these have been automatic for the CMH units, but this is you're now telling us that these units exist. Okay. And so I filled in all of that. And then whatever services are included, then I go back to the list of properties. They are now in there. And if there's anything in this section at all, like under provincial units, then what happens, so I'm going to go over to the financial pages, the operations page, And now what I have is I have a section here called Part B, Other Housing Operations, and I have a statement of operations for those units. Before, in the old days, what we did is for non-CMHC units, we just had a very short Schedule T, which just had a few lines on it. And now what we're asking for are full statements of operations for all units in the co-op. So for the provincial, this would be the first year for the provincial program, where you'd fill out the entire statement of operations. And the trick here is that if I go back to properties and units, and let's say I don't enter those, like if I delete that property there, it says, are you sure this will clear all B1 data, which means a statement of operations. But if I haven't actually put the units in, or I forget to do that, then I go to statement of operations, and this is, well, it's not supposed to go there. Interesting. Well, it's not doing what I want it to do, but what you would find is that, there's a bug in there because it's supposed to take me just to the CMHC statement of operations. But at any rate, if it's working right, there won't be any place to enter that provincial program operation data. So you have to come back here and fill this in. Or we've had some situations where we've been getting calls because they're going, well, you've gotten rid of Schedule T. Where am I supposed to put it? Anyway, just knowing this section exists is useful, but you only have to put something in if you have non-CMHC units, because even the former CMHC units will appear right up here also. Any questions on that? Okay. So next, what we're going to go through, we're going to go to ScheduleML, the mortgage and loans where the most of the changes have happened. And it's going to take me a minute to get there. So going to ScheduleML, and ScheduleML looks completely different than it did before and asks for more information. There's a number of reasons we've made the changes. The main one is that, especially with workouts, we find is that we're not infrequently asking auditors for more information, so we can figure out exactly what's going on with the workout. And we think by making this change, we'll be coming back to you less frequently, and that'll save both us time and you all time from having to look at files you haven't looked at for a few months, and that all the information that we're asking for is readily available at the time that you're actually doing the audit and filling out the AIR. So I'm going to go through. By the time we get done, we'll have gone through all the sections, not necessarily in order. And that previously in ScheduleML, each loan was on one line, and now each loan is on one column. And so over on the left is just the description of the line. Then there's the number for each line. And again, like I said before, there's context sensitive help that I hit 110 and it took me to line ML 110 in terms of exactly what we're looking for here. Starting with the loan identification section here, all of this for pre-existing loans, all of this should be pre-populated and not changeable by the user. If you happen to see any mistakes in here, what you can either do is just let us know at the time, and we can go and change it in the background. Or what you can do is under Audit Accountant's Report, there's a section for additional observations, and you can just always use that section to put any notes, just to let us know, hey, this needs to be changed. And because we always look at that, and really what's ever more convenient for you. So that's what you'll find in the loan identification section. And then the next section is loan terms. And these are the 200 numbers here. And one of the changes, one of the different wrinkles in previous versions, if there was, when a loan is in its final term, because we have two dates here, we have the next loan renewal date and we have the amortization period end date. And in the past, if a loan was in its final term, that often the next loan renewal date and the amortization period end date would be the same date. So in this situation, it would be April 1st, 2021. Well, we no longer allow those dates to be the same. And so the thing to do is if there is no additional renewal date, what you can do is by this button right here, if you just, it's normally checked. If you uncheck it, it will just turn into NA. And NA really means that there are no more loan renewals. And there's a little, if you hover over it, you get the little help message right here. And the other thing is that this information reported in this section should be current as of the AR filing date, not the fiscal year-end date. So it will no longer allow you to put in a date that's in the past. It also makes sure that the amortization period end date is later than the next loan renewal date. So there's a couple more rules in here that basically force you to sort of answer questions in a certain way. Okay. So here, now what I'm going to do is I'm going to go through, one of the things is you'll see that, actually I'm going to go through now each of the loans individually, the rest of the sections. And so in this situation, well, we have, as it shows up on top, a loan priority, whether it's a first, second, or third mortgage, whether it's a workout loan or not, that's a new section, who the lender is. In this case, it's all CMHC. And then whether it's a charge against the CMHC program property, that is an already existing field. Okay, so going through the individual loans here. And all the white boxes are boxes that you can populate that can be changed, and the gray boxes are ones that you can't change. And so first we get into the loan terms where it's, whatever the current monthly payment, the interest rate, and like we said, the term and the amortization period end date. You'd enter the next section here. So we have the first mortgage here, and so there's the balance at the beginning, and that's pre-populated and just comes from the previous year. Then if there are any advances, and then if there's any interest added to the loan principal, basically interest that's not paid is added to loan principal. We'll get more to that later. And then you actually enter what were the principal payments for the year, because we're asking you to separate that for interest payments that are lower down. And in every section, we have an other that you can, in case you need to make an adjustment, there's a way so that you can actually reconcile the beginning to the end. And then next we have the accrued interest at the beginning of the year, and these in the first year will be editable because we know what the total interest is, the 4267 in this situation, because we have that from the previous AIR. We may not have it exactly correct how that's distributed. Actually, all of these, the 3695 should be editable too, and the 0 should. It's just an old bug in the program that's since been fixed. So you can actually adjust them as long as you keep the total the same. You can't change the 4627 because that's from the previous AIR and financial statements. And then what the interest expense was, which is different than the interest payment by the amount of generally the change in the accrued interest. And then you put in all the numbers and it should give the accrued interest at the end of the year. And again, we use the other, and whenever you put something in the other, I put that $45 in, then you have to put a note in. And in this situation, I just, the note was adjust to actual, because there's often small amounts that need to be adjusted for. And if it was a significant amount, then we'd want an explanation more than just adjust to actual, such as over here. Actually, that wasn't a very good explanation, VV. Anyway, for something that large, we'd expect an explanation of why is there a larger change. So that's the interest section. And we'll get to the 710 section in a couple minutes. And then down below, we ask the question, do any of the amounts reported above differ from amounts shown on the statement of account from the lender? This is often a place where we see there are differences. And so here, the nominal answer that you can answer is no. Over here, if the answer was yes, what we're looking for is an explanation. And what we say, if it's a very small difference, just very small difference is a good explanation. If it's something other than that, if it's not a small difference, then we'd like an explanation. Why does this differ from the statement of operations from the lender? Going back to the top here, there's a section 700 here, forgivable interest asset. And this applies only to, only in British Columbia, to certain workout loans. And these are only loans where, on a contractual basis, that if the co-op follows the rules, then a percentage, usually 50%, is forgiven at the end of the term of the loan. CMHC theoretically can forgive accrued, deferred interest, or actually interest that's been paid. They could theoretically forgive interest on a workout loan, but it's extremely rarely done, except for these contractually forgivable interest situations in BC. And so what we're doing here is need to enter the percentage in the first year, so it's 50%. And what we have here is that, and then the forgivable interest asset at the beginning of the year, this again does not allow entry, but in the corrected version now, it's a bug that's been fixed. You'd enter what the amount was at the beginning of the year for the first year, so you can initialize the system. And what happens is, then the system calculates the forgivable interest for the current year. So up here we had interest expense up on line 620 of 11,000. Well, 50% of that is 5,500, and so what we have is that 5,500 was the net change during the year. There actually should be an amount up here at the beginning of the year, but it's not. It's not in there because of a bug in the program, and I can't put it in. But the net change in forgivable interest during the year is 5,500, and then it gives what the forgivable interest is at the end of the year. And that amount, what we do is we treat that actually as an asset. So the entire loan balance is a liability, but what we're only doing now is in any given year is actually expensing as interest the 50% that's actually repayable, and setting up as an asset that 50% that's going to be forgivable. And I'll show you more on that in a minute. And some of this relates to changes in the special purpose framework, which we'll go to in a minute. But one of the things you'll notice here on the statement of financial position is line 255, which is deferred interest charges. It's a little bit larger. Which last year was the 267,000 in here. It no longer appears. We've gotten rid of line 255. And what's happened is in the initial balances, the 255 has been incorporated into line 240 in ScheduleML. So often on financial statements, this will now more look like your financial statements. We had separated out anything that was deferred interest in the liability section, and now it's just combined. And so that's the liability aspect of it. And but again, the total that we pre-populated should be correct, so it shouldn't present any problem. Just the 255 has been incorporated into line 240. I'm going to go back to the schedule. What happens here now is, let's try something here. Let's see. When I click save up in the corner, okay, let me actually, I'm going to click save again. And what happens is when I click save, is I often will get some error messages up in the upper left-hand corner, and it asks me to fix the thing. So for instance, it says loan 205, line 205, loan 3. Okay, line 205, loan 3 over here. The field must not be blank, but 0 is a valid entry. So what? On some of the fields, you're actually required to put in an entry. Put something in, and oftentimes it just starts as blank. And for instance, there are 0 current monthly payments here, but I'd forgotten to put that in. And so it will remind me of those things. In the next message, it's important. You may exit this page now, but the above items will need to be addressed before the AR is filed. So it's not going to force you to stay on this page. At this point, it's a warning message, just this exists, but it allows you to move around and go other places, but it won't actually let you file the AIR unless this issue has been resolved. Okay. Any questions so far? That's a lot of information. Okay, I'm now going to, that all had to do with existing loans, and I'm now going to go and to a different of my housing co-ops here, and oh, interesting. Not going to let me go where I want to go. Fascinating. Okay, well, I'll go somewhere else. So what there is here is occasionally there's a new loan, and over on the right-hand side, we'll see that it's actually, a couple other things that I want to do here first to show you that we have across the top loan 1, loan 2, loan 3. And basically they're in a particular order here. First are the CMHC program loans, the ILM, which is a CMHC program, and then it goes first mortgage, second mortgage. Then it goes to the provincial program loan. And if you put a new loan in, it will slot itself in the right place. So, and then over further on the left, we have this column that's all loans here. And if there's more than one loan for a particular program, in this case we have 2 ILM loans, you'll have a subtotal column here. And so here I'm going to add a new loan, and it's interesting, it should have, I don't know why it doesn't have, it should allow me to put in either a provincial or an ILM loan. What we're actually looking right here is on a system that's a couple months old, so it still has some bugs that have been worked out. But it should allow me to pick either an ILM or provincial, because those are the programs I have. I'll pick an ILM loan, and basically it will pre-populate anything that it can. For instance, there's only one agreement, one ILM agreement, and so it puts that in there. Otherwise, it would give me a drop-down menu if there were multiple ILM agreements, and I have to select one. And I'm going to just say that this is I'm going to just call this a third mortgage. And I'm going to say yes, it's a workout loan. And then it gives me a drop down of who the possible lenders are. And there's always an other category at the bottom where I can fill it in. But workout loans are always CMHC, generally CMHC. And then there's this message here. You need to complete all the rows above and select save before you can continue, because you can see that nothing exists below it. So now I click on save, and it did not work. Okay, let's try again. Interesting. What did it do? It did something very strange. It looked like it deleted one of my loans. I'm glad this is an old thing that we've worked out the bugs for. So I'm going to just say this new loan is loan 2. And what it's done here is that it's a workout loan. So I need to put in the current monthly payment, which I'll say is $1,000, and the interest rate is 2%. And you'll see here that lines 215 to 225, the next loan renewal date, the term, and the amortization period end date, there's nothing to fill in. For workout loans and for ILM first mortgages, we've just stopped using those and don't even have you fill them in, because they just don't make a lot of sense. They're quite confusing and they're non-definable in a number of situations. So this is just one of the things that we've gotten rid of. Okay, on this new loan, of course, there was a zero balance at the beginning of the year. We'll say there's some advances and some principal repayments, and then an interest expense, interest payments. Oh, I have that backwards, so. And it calculates the accrued interest. Then I go down here, was it consistent with the statement of accounts? And I say, no, there were no differences. And so I've now filled in everything for that new loan. And you can see in the upper left-hand corner, there were a bunch of error messages that came up because I hadn't filled them in yet. If I go and hit save again, oh, there's one thing. It's 690 loan 3 is 0. Confirm this is correct. Okay, 690 loan 3. Because that one says that there's no accrued interest, and so that I'll just leave there because it is correct that it's 0. So it's asking me a question at this point. What else did I want to say? That was a bit confusing because there were it created some errors that were a bit bogus there, and I think it deleted one of my loans that was in there. It should not do that. Those are basically, you spend a lot of time working out the bugs. If you see any bugs in here at all, just let me know and we'll get it fixed right away. There should be very few that are left in here. Okay, and I'm gonna go to another co-op, show you one other thing. It's called, where's my, okay. Well, actually for some reason, there are two items that it's not allowing me to go into here. If you go into the ScheduleML and it's empty, there aren't any loans showing, and you're going, wait, there are loans, then just again, let us know, because that would just mean the pre-population data didn't work, and so you have an empty schedule. And again, we can just fix that up for you. There's two other things I want to show you here. One is this line that is line 330, interest added to the loan principal. So in a situation where the interest is not being paid and it's being deferred, or the total payments were less than the interest expense for that period, then the interest is just added onto the mortgage principal, and basically that amount can be added in here because it's one of the ways that the principal can increase during the year. And then what it does, it also carries it down to line 650 in order so that the accrued interest isn't overstated, because we think of the accrued interest as being, well, just any interest that was for the previous monthly period or previous period in there. And the other thing that I'm not able to show is there's another section that's for a co-op that has forgivable mortgages. These are just section 27 and section 61 co-ops. And so that section, it's shown here. It's a 400 section that's shown for those co-ops. And again, because my system's not quite working today, I can't show it. But again, so you can see sections only show up if they're applicable to a particular co-op, and sometimes lines or columns will only show up if it's actually applicable to a particular loan. Okay, that's ScheduleML. Again, any questions about ScheduleML? And you'll see in your handout where there is a lot of detail for particular situations, of most of which we've gone through, because what we've tried to do in the handout is give you most of the things that you might run into, and there's actually more detail in here than there is in the guide itself. Just figuring that that'll answer a lot of your questions. And the next thing I want to do then is go into the special purpose framework. Oh, just in terms of this AIR, this version of the AIR, it's any AIRs that were started as of June 13th, I think as of June 13th, the last time we did this webinar, forward will be this new version. And any AIRs started before then is the old version. Okay.
And just a reminder to everybody to unmute yourself if you have a question.
Okay, the special purpose framework. I'll be there in just a minute. So the special purpose framework has been in existence really from the beginning. The term special purpose framework didn't exist back in the old days. In the old days, that a nonprofit organization could pretty much had great flexibility in how it was allowed under GAAP to do financial statements. And then slowly over the years, those regulations have tightened up. And the formal concept of a special purpose framework came into effect some years ago. And the key aspects of the special purpose framework, the most important one we went over before was that for housing co-ops, federal housing co-ops, were that amortization of capital assets was based not on useful life, but was based on principal repayment. And so the amortization of principal repayment, the interest expense would be close to the interest actually paid, only different by the amount of change in accrued interest. And what that basically meant on the financial statements, the actual mortgage payments very much matched the amortization and interest expense on the financial statements. And the purpose of that was so that the co-op's budgets and their financial statements were comparable. And so it's been relatively easy to do a comparison. We're comparing apples and apples.
Further to that, Larry, it might be worth mentioning that land also gets amortized as the principal gets repaid. I know that can be really hard for accountants.
Yeah, which is utterly absurd in terms of the real world. But what it means is that at the end of the day, once the loan is paid off, that what you have is the capital assets are zero and the loan is zero. So in a sense, what happens is because the capital assets and the loan liability are always offsetting each other, that a financial statement in a sense is really looking at current assets and current liabilities, and you can see and any surplus or deficit basically takes aside the long, sets aside the long term, and that's how it was intended. A few other things in terms of and that was the key aspect of the special purpose framework. Other ones were that the way that the allocation to the replacement reserve are made are considered an expense when the allocation is made. And we'll go through a few of the others. And so what's happened is there were a number of things that the special purpose framework did not, and the special purpose framework was, some of it was in the aspects were in the actual agreements, the operating agreements between CMHC and the co-ops, and other aspects of the special purpose framework just came out bit by bit over the years, and but it had never all been really written down in one place. And what we did is at the agency a few years ago, we started reviewing it all because we noticed that different financial statements, different auditors were doing different things with, quote, the special purpose framework. And what we were looking for was hopefully to come up with a consensus of just what the special purpose framework is and get some more consistency in how it was used. Well, we did a major consultation and did not come up with a consensus. So what we did is we basically took all the input and came up with what I'll show you here now. And essentially what we did is we went, our starting point was, unless there's a really good reason for not using GAAP, use GAAP. And you'll see how we've moved more towards GAAP in a number of ways. So here's the document that's been circulated to you, and it has the introduction and some of the background information and the rationale for the special purpose for the changes, which I've gone over some. and then actually the policies. And I'm going to go through the policies now. And the first one that talk about is accounting for capital assets. And the first one is the crux of the special purpose framework. Capital assets acquired through proceeds of any loan other than workout loan, including the original land purchase, are accounted for at cost and amortized to income at the rate the loan principal is repaid. So that's the crux, and that's very traditional. What's changed here is, and where the special purpose framework got us all in trouble had to do with workout loans, workout funded assets, because with workout funded assets, the loans are often, first of all, the loan doesn't start getting paid for a number of years, then it might get some lump sum payments, and it can basically just vary a lot. And so how do you, and so the amortization of traditionally has been, well, amortizing according to principal repayment just didn't really make any sense. And so in the end, what we decided that essentially the goal of the special purpose framework, oh, I'm going to close the window here, I'll be right back. I think somebody's mowing their lawn. So that the goal of having be able to match the budget to the financial statements, once you're in a workout, the special purpose framework just breaks no matter how you do amortization. And with workouts, we have more detailed tools that we do and more detailed reviews. And so we've just basically said, okay, the AIRs just not, and the financial statements just aren't going to work in the way it was originally meant to, around the budget matching or be comparable to the financial statements. And in the end, we just said, okay, since it doesn't work it just kind of breaks the system, let's just go to GAAP. And so we're saying that any capital assets, this is point 2 here, acquired through a workout loan recorded, and estimated useful life, excuse me, on a straight line basis. And that's a change. And then just to be clear, any land purchase subsequent to the original development, is a permanent asset and not amortized. So based on this, we've come up with a number of observations, and we deal with the situation in here. I won't go into all the detail, but what if the loan exceeds one of the capital assets? What if the loan is less than the capital assets? And how to deal with those situations? And basically, both situations, if it's amortized at the rate of loan principal or assets that are funded through a workout loan. And in general, the general concept has been that if an asset is loan funded or grant funded, then capitalize it, and otherwise expense it, don't capitalize it. And so just basically tie the amount that however you amortize it, basically just capitalize the loan or grant funded portion. And what we are is we're in a number of in writing this, you'll see that we're not explicit about the issue of whether something's applied retrospectively or not. Our understanding of the handbook is that if it's, I think the word is practicable or practical, if it's practical, then have a retrospective application. And if it's not practical, then just do it on a go-forward basis. And our preference for workout workout funded assets would be actually to apply it retrospectively. Again, if it's practical, but again, we're silent on this because because in a way we don't want this while we have preferences, we didn't want to set up something that in the special purpose framework which contradicts the handbook, because even within the special purpose framework, it's not, the special purpose framework can't say ignore the handbook. It can change certain things but not other things, and the retrospective aspect was one of the tricky ones that we ran into. And so we're just basically saying here are our preferences, and you'll have to, and what we found is different auditors interpret the handbook differently around the retrospective and what's practical and what's not. And so we just sort of leave that to you all, just saying that our preferences to kind of clean things up in a way, because our ideal would be for consistency, because with consistency, it just makes it easier for all of us. And again, to reiterate a point I think Joe may have brought up, probably the most important thing is that the notes of the financial statements actually reflect what's on the statements itself, so that we can look at the notes of the financial statements and know exactly what the statements represent. Well, over 95% of co-ops use the special purpose framework. That what's most important is knows what's actually happening, even more so than whether our preferences in the special purpose framework is followed. So that's probably the biggest change in sort of special purpose framework, is that workout loans, we're recommending that they be amortized over useful life rather than at the rate of loan principal, and if possible to make that a retrospective application. And then we go into grant funded assets. And again, I won't go into the detail here, but again, what we're saying as pretty much treating them the same as workout loans, and that are amortized over their useful life, and that the grant supporting the expenditure is reported initially as deferred revenue and amortized to income at the same rate. And we deal again with where the observations where the cost of a capital asset is different than the actual amount of the grant. And one of the things that we want to point out here is that the special purpose framework here in terms of for grant funded assets is different than what we've said for the renovation and retrofit programs in the past. And so the key on that is we're saying that no change should be made to the treatment for the renovations. We're saying, don't go back and try to change those. We just recognize that there was a difference in what we recommended in the past. So this would be for grants, going forward. The next, and then there's assets funded through restricted reserves. And again, very simply, this is not a change, but just that any capital assets funded from the capital replacement reserve or another reserve are just expensed to reserves in full when made. And we've had, I think, one or two situations where auditors have chosen the money comes out of the reserve and it's also capitalized. And again, the AIR is set up to allow that. The AIR itself is agnostic in the sense of whether a co-op uses a special purpose framework, uses GAAP, or uses a combination of those two, and it's set up to basically handle any situation. And then there are other capital assets that are not funded through, that don't go through reserve and are not either grant or loan funded. And there's very few of these that come up, and we're just, the policy has been that they're just expense to operations when acquired. Okay, I see. I see a question, Jill. I see a question in the chat. This was quite a while ago. I think it was Michelle. Make me the
Larry,
presenter.
I answered it.
You got with that? Okay, thanks.
I did. Yeah.
Okay. Okay. So now we get down to accounting for interest charges, and this is also a change from the special purpose framework as we had it before. Basically, what we excuse me, said before, that in workouts, when there's interest that's deferred, and often it's deferred for quite a while, to not expense the interest when it's accrued, but to expense the interest when it's actually paid. And now, again, we're changing that to say, don't defer interest and clear any deferred interest that may exist, and essentially going to GAAP on this. And so we're basically saying very simply that all repayable interest charges on the loan, including contractually deferred interest charges, are expense to operations when incurred, which is just normal accounting practices. And it says, again, the above policy departs from the longstanding and dominant practice among agency clients of recording contractually deferred interest charges as negative equity on the statement of financial position. And cooperatives that have followed that practice will need to reverse the accumulated deferred interest charges through a charge to accumulated surplus and deficit. And the hows to on actually doing this are in the AIR guide itself. So that will so that will take in the first year actually saying is doing a one-time clearing that deferred interest to accumulated surplus or deficit. Excuse me. And the second point here is some co-ops have capitalized contractually deferred interest charges as part of the cost of the capital assets. So, for instance, the capital asset may have cost $1 million actual cost, but the deferred interest of another $1 million may all have been capitalized. So you actually have a capitalized asset of $2 million. And rather than putting that as negative equity, actually adding it to the asset itself. And we're suggesting that this needs to be cleared because the only interest that actually should be capitalized as part of the asset would be normally like interest during construction and whatnot, just following the normal rules. Excuse me, and not that large amount that may have been deferred. And the third point here is that some co-ops have reported interest charges on a cash basis rather than an accrual basis. And again, this is just an occasional thing, but this is not GAAP, and we're saying please don't continue that. And then the last point is that the point 4 here is that some co-ops have reported accrued interest as the full amount of the mortgage payment due the next day. Excuse me. And we're saying, again, this doesn't conform to GAAP, nor is mandated by CMHC, and we'd like that to be discontinued. There are some historical reasons why that happened, but we'd like to do is clear it out. So it comes down to very simply in terms of accounting for interest charges, going forward, use GAAP and make the adjustments necessary to go there. Then we get into forgivable charges, and that's the part that we talked about. That's the 700 lines on ScheduleML, and those are strictly the BC co-ops where there's contractually forgivable interest. And I won't go into the details here, but the special purpose framework does cover that. And what to do if it was forgivable and then needs to be repaid ultimately. Okay, going on to accounting for reserves. Again, there's nothing new in here at all, simply that contributions to reserves are appropriated annually from operations for the capital replacement reserve. Expenditures are charged directly to reserve, and earnings, interest earnings, are allocated directly to the reserve. And then we go on to the security of tenure reserve and the subsidy surplus reserve, and again, go through these, but there's nothing new about these, but they clarify in case there are any questions about what to do with those. And also that noting once again, these reserves cannot have negative balances. Occasionally we see negative balances on the financial statements. Those are not allowed on the AIR, and those are few and far between. We see that, but that those balances may not be negative. Then we get onto GST. And again, the policy, the non-recoverable portion of GST or HST is part of the cost of the goods or services purchased, and the recoverable portion is treated a reduction in the cost of goods or services. And again, that's straight normal accounting practices. And it's the way that like PST sales tax, differential sales tax is always treated. So we're basically saying the special purpose framework just follows GAAP, but there have been a couple of the observations deal with situations where the accounting for co-ops has been different. One is that on the AIR, there's a line that's GST. Let's see, yeah, on there, there's a line that says GST, and that's in situations where the GST was separated out and wasn't included as part of the cost of goods. We discourage that, using that practice, and would like the bookkeeping and accounting to actually not use that line. For instance, there's no comparable line for provincial sales tax, and what the problem with having the separate GST line is that we can't compare from co-op to co-op apples. We don't have a comparison apples to apples. So for instance, like maintenance costs, well, for one co-op, it may include the GST and the other it may not. So again, where possible, and this really has to do with how the bookkeeping's done, is just that to include the cost of GST or HST, the non-refundable portion, the same as provincial sales tax would be. It's just part of the cost of the item itself. So that's one issue. And the other issue has to do, and this is mostly, possibly entirely in BC, but mostly in BC, where any refunds, rebates from loan-funded capital assets, in terms of rebates for the out here the GST, would be considered revenue rather than reducing the cost of the asset. And that was done and the reason for that was because CMHC wanted to be able to see that and basically recover those funds as part of the mortgage payments. And so what we're saying is, going forward on the financial statements, and they don't do that. but basically just treat it as a reduction in the cost of the asset, again, just according to GAAP. And then in terms of making those adjustments for the purpose of repayments to CMHC, we deal with that internally when we do financial statement. Basically, we do reviews every year to determine what we call cash sweeps, or what extra mortgage payments there should be made. Again, what we're trying to do is get away from, well, no, that's a different issue, but anyway, so again, the simple thing on GST is just account for it according to GAAP. And then another issue, which is not a policy, it's a presentation issue of what we've seen, that due to and due from lines on a financial statement. So co-ops that use fund accounting methods need to report amounts due to and from on the statement. And so what we want to do for clarity and to avoid overstating the assets or liabilities, it should just be on one line that totals to zero, because if it's shown in both, if part of it's shown in the asset section, part in the liability section, then it overstates the total assets and liabilities, and also then the total assets and liabilities between the financial statements don't match. So just do the one line. And also, where there's not fund accounting used, then there should not be any due to or due from lines on the financial statements at all. And especially in the worst of the situations, we've seen financial statements where it actually, if you don't look closely, it inflates what looks like the actual cash for the co-op. So again, that's just a presentation issue. In the special purpose framework document, what we've done is we've offered some sample financial statement text for like the financial statement notes. And we've drawn these from a number of actual financial statements from them. And where we think that these notes can be most useful is for auditors who are less familiar with the federal co-op program, because we're no way trying to tell y'all how to do your notes. This is offered strictly as some examples of ones, and it covers all of the special purpose framework issues. So first of all, the report, and then the notes, and it covers, again, like when I say it covers all of the policies that are up above in the special purpose framework. And first, what we have are items that are special purpose framework, and then what we have later, other significant accounting policies. These are not special purpose framework, but they're ones that may or might be included somewhere else in the notes of the financial statement. For instance, you might have capital under the special purpose framework, capital assets acquired through the proceeds of any other loan from a workout loan. That's a special purpose framework issue, but then there are how other capital assets are acquired. Like here, capital assets acquired through proceeds of a workout loan are recorded costs, because again, if there's different ways that capital assets are treated somewhere in the notes, they're going to be, whether in the same place or different places, it's going to indicate how they're dealt with. The first section here, under the basis of accounting, these are talked about in terms of ways that it differs from the handbook. Whereas this lower section, the other significant accounting policies, are examples, not that it's different from the handbook, but they might be appropriate to be in the financial statements, just to define how things are done. So that's, now I'd like to open up to any questions or comments that anyone has, or anything that you'd like to have clarified. Jill, is there anything you wanted to add?
No, I think I jumped in when I needed to.
Okay, give it a go.
This is your opportunity.
Is the special purpose framework document you have been showing going to be posted? Yes, it's, let me show you, I just see that. Let me just show you where you can, a couple places you can find it. One of the things I'm going to do is after, like over the last few months, we've sent out various emails that had some of these things attached and references them. I'll be sending out one more email that will have all of the documents, including the special purpose framework, attached in the email, so you can have it all in one place. It's also, when you go into the AIR itself, let's see, no, I don't, this isn't quite the right one. I've got to go to a different one. Bear with me for a minute. And see your list of co-ops. If you go to help for auditors and accountants and go to the reference documents, you'll see that the special purpose framework accounting for housing co-ops is actually right there, and you can open it up, download it, and it's right there. So it's always available online in Chase itself, and that's just where I got the one I went through today. Also, like I said, also I'm going to send it in an email to all audit firms with an encouragement that you circulate the email to anyone who works on the AIRs, because I thought having one email with all the resources in one place could be useful, as well as that they're all available online. And I also will be sending out, assuming the recording of this, which it seems to be working, I'll be sending out a link to this webinar also, in case anybody wants to watch it. Because there's some folks who weren't able to come today that they like that. So.
Do you see the next question there, Larry?
Okay.
Couple more.
Sure. Okay, let's go. Let's see. Okay, let me go through there. Regarding capital assets, the only area adhering to GAAP is workout loans. Not sure I understand why there are changes was made, and 3 other areas are not GAAP. I'm not sure what the 3 other areas are. I understand the first one. I mean, the core area that's not GAAP, which is the basis of the. So if you want to clarify that or come and clarify the question, that'd be great. But in terms of the main area in terms of capital assets that are not GAAP are, one is that the original, well, anything that's not a workout loan, those assets are amortized according to principal repayment. And again, the basis for that, the original intent on that was so that a co-op's budget could be comparable to their financial statements, and that that desire hasn't changed, and so that's continuing on. And also that in terms of capital assets that go through the replacement reserve, the idea is that's considered, the expense is considered when it's the allocations made to the reserve, and again, so that the budget and the financial statements can be comparable, and so that's why those aren't made. It's more the reason that was made in terms of the workout loans was simply because we found there's no advantage that with workout loans, no matter how that with workout loans, workout loans basically break the special purpose framework goal of having the budget and the actuals match are comparable, and so because because of that, there was no reason to have it be anything other than GAAP. I'm not sure if that answered the question. If not, you could either come online and ask, or just write another message, or I'd be happy to discuss it outside the meeting too. Can you please ensure the email also goes to people that logged on to today's session? Okay, assuming that, assuming that, I mean, it will go to all of the audit, basically the email will go to all the audit firms and the main contact there. I'm not sure if you're asking like that for, if put it this way, if when people logged on, if I have a record of their emails and there are other auditors in the audit firm, they'll go out to them too. I'm not sure what record I have, but I'll make sure that as well as the main contacts, any other auditors that have come today will get the email, but I'm not sure exactly how that works. But at least every firm will get one.
So I'll also mention here that if there are changes to your firm name and particularly to your firm's emails, please let us know, because I think there was at least one case where probably the notice of the meeting went to the old email address that we had, not the firm's new email addresses.
Okay. And another question, what's the difference between workout loan and government funded loans? That a workout, basically when a co-op is in financial difficulty, sometimes CMHC will actually create what's called a workout with them, and then will provide second and third and sometimes fourth mortgages that basically to assist them. And they're actually, basically it'd be any loan that's within an official workout. There are occasionally, and for instance, there's the first mortgages, the original mortgages were government funded or government guaranteed loans. They weren't workout loans. And occasionally, CMHC provides loans to co-ops that are not workout loans, like a second mortgage, where the co-op's not in financial difficulty, but they actually provide the funding. That would not be a workout loan. Those are few and far between. Okay. Okay, next question. Once the operating agreement is over, as well as any supplementary subsidy programs end, can the co-op cease using the special purpose framework and fully switch to GAAP? So, basically, once the co-op is out of its operating agreement, not only can it change to GAAP, I believe it's obligated to go to GAAP, because the only reason that a co-op is allowed to use a special purpose framework is because it's mandated. So the way this works, in a year, if the year following, let's say that a co-op's fiscal year end is December 31st. For most co-ops, their operating agreement will end on December 31st or January 1st. And so it's a clean sweep. That year, the year before it ends, the year, is special purpose framework. The year after is not special purpose framework. If you have a co-op where the operating agreement ends in the middle of a year, that year would be special purpose framework, and then the next year, the first full year out of the operating agreement would be not a special purpose framework. There's also another part of that question referring to any supplementary subsidy programs. So what happened is that the CMHC, a lot of co-ops, their operating agreements ended between like 2016 and 2020, and what the government did as a interim measure was extend operating agreements first, I think it was through March 2018 and now through March 2020. And all those co-ops, their operating agreements will end in their end sometime like in 2020. And so once they're out of their operating agreement, then they would no longer be tied to the special purpose framework. There is and the way this question was asked, supplementary subsidy programs. Well, we're expecting any time for the government to announce a longer term subsidy program up to I think 10 years. And those, like the way the supplementary programs have happened up to date, the operating agreements themselves were extended. Our understanding is that with the supplementary, the next program that's going to come longer term, that will not be tied into the operating agreement. The operating agreements will end, and that will be a separate program. And at that point, even though there will be these supplementary programs, and we don't know yet whether or not the government is going to continue, whether there'll continue to be AIRs or not. But once there's no operating agreement, even though there will be these subsidy programs, then our understanding is that the special purpose framework will no longer be used because it won't be tied into a requirement of the subsidy program or a requirement of a no longer existing operating agreement. And that's also a long-winded way of saying that we will clarify that as soon as we know. We're expecting announcements within the next couple of months exactly how that will work. So again, in simple terms, once the operating agreement itself ends, then the special purpose framework ends, regardless of whether or not there is a new subsidy program. Okay. That's the last of the questions. Is there anything else? Any other questions or comments? Okay, I think going once. Again, you can contact Jill or me at any point on this. Again, thank you so much for attending. I hope this is really useful and will the hour and a half that you've invested today will be paid back to you in saving time and headaches and doing financial statements and AIRs. And again, I think I'm going to, if I can figure it out, I'm going to close the meeting now.
Bye, everyone.
Bye.
It's on the client's website.